Hello everyone and welcome to another edition of the Money Pros. I'm Oliver Tutt, Certified Financial Planner Practitioner, and I'll be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. So we've got a lot to talk about on today's show. Let me give you an idea of what we're going to be covering. First off, we're going to be talking about something interesting going on Wall Street, not so much about market performance, which has been excellent lately. We've talked about that on the show a bit, and I hope to be able to continue to do that as the months go by. But we're going to be talking about trading volumes on Wall Street, which is the quantity of stocks that get traded on a day-to-day basis. There's an interesting trend going on. So we're going to cover that in the first segment. Then we're going to switch over to real estate. We're going to be talking to our real estate pro, Chad Kritzas from Keller Realty. We're going to be talking about the age-old question in real estate: should I rent or should I buy? So Chad is going to fill us in on some of the details on how to balance those considerations for you choosing where you're going to live. Then in our third segment, we're going to be talking about a very interesting Wall Street Journal piece that came out a couple of weeks ago regarding Morningstar. Some of you may be familiar with Morningstar. They're a giant in the mutual fund industry. They are in the business of ranking mutual funds, and their star ratings recently came under a little bit of fire from Wall Street Journal. So I thought I'd talk about some of the hot button issues with respect to that article because I found it pretty interesting myself. And then finally, we're going to answer a viewer question on whether we're looking at a market correction coming up. So we're going to talk about all those things. Let's jump right into it. And let's talk about the market and talk about an interesting trend that we're seeing now. This episode of the Money Pros is being taped in mid-November, and that gives us a couple of weeks to look at what's gone on so far this year, particularly up through October, and some interesting trends taking place with respect to October and, in fact, through the summer, not just in terms of performance, which, as I mentioned, has been very, very good, but also with respect to trading volume. So what is trading volume? The stock market is just that. It's a market, but instead of groceries or electronics, people are trading stocks. So you have buyers and you have sellers, and the volume is the quantity of stock that changes hands. And investors look at trading volumes very closely, whether it be on a daily, hourly even, or a weekly, monthly, yearly basis, because it tells us a lot about the health of the stock market and what traders are thinking, whether or not they're trading. And the trends are pretty distinct. So as we look at October trading volumes, and this is across multiple stock markets, so not just the New York Stock Exchange, but also the NASDAQ exchange, as well as the New York Stock Exchange American Exchange, which used to be the old American Exchange. So a variety of different stock exchanges, definitely seeing a trend toward dramatically decreased stock trading volumes. In fact, for October volumes, they were down 12% versus the average for all of 2017. So October was a particularly slow trading month in the stock markets, but further down 22% from the 2016 average. So 2017 overall is down from 2016, and October of 2017 is down dramatically versus the year overall as well as last year. Trading volumes in exchange-traded funds. We talk a lot about exchange-traded funds on this program. I'm a big believer in exchange-traded funds. We're seeing those volumes down significantly, down 8.5% from a year ago, October. So a dramatic downturn in not only stock trading volumes, but also exchange trading volumes. So it's really an interesting story. Let's talk about some of the reasons for this. Let's go to a slide really quickly and we'll run them down. The first one is ultra-low volatility. The CBO Volatility Index, some of you may know that as the VIX, is a measure of volatility in the market, is at a 20-year low right now. The reality is the market is just not bouncing around a whole lot. So a lot of investors are looking at that and say, if it's not bouncing up and down and the general trend is up, I might as well stick with it. Next reason, and this is a big one, lack of market-moving news. Now, we've had plenty of news. We've had some interest rate changes. We've had the threat of war with North Korea. No big deal, right? But interestingly enough, what news we do have doesn't seem to be moving markets much. In fact, we have these big news days, whether it be politically, internationally, in some cases economic news, but generally the economic news has been pretty muted, and it just hasn't been moving the markets. So there's been a lack of news that has contributed to lower market volumes. Last reason on the slide here, the rise of passive investments. Now, I just got done saying that I'm a big believer in exchange-traded funds. Exchange-traded funds are really leading the trend toward passive investing. The idea that you're not going to try to choose between Coke and Pepsi, the winners and the losers, but what you're going to try to do is just own the market. And that's passive index investing. And the nature of passive index investing simply applies that I'm going to buy the market and I'm going to hang on to it. Now, that's a trend that's increased significantly over the years. In fact, BlackRock, that manages a lot of exchange-traded funds, and Vanguard, which is the second largest manager of exchange-traded funds, have $10.7 billion in assets invested in passive strategies. And these are strategies that people just simply tend to hang on to. So the rise of passive investing has also contributed to decreased trading volume. So as long as the news is good, or at least even, and performance is good, volatility is low, and passive index investing keeps taking hold, I think you're going to see continued decreased volumes on Wall Street. All right, that's it on that. Let's talk about real estate next with our real estate pro, Chad Kritzas with Keller Williams Realty. Should you rent or buy? Stay with us. We'll be right back. Welcome back to the Money Pros. I'm with our real estate pro, Chad Kritzas from Keller Williams Realty. Chad, thanks for being back with us.
Thank you.
Interesting topic today, but as we always do before we leap into our interesting topic of the day, we want to get your feedback on where we're at in the market now. I referenced early in the show, as we're taping this, we're mid-November. We're heading into Thanksgiving. Christmas will be soon to follow after that. How is the real estate market so far year to date in Rhode Island, whether it be as we're leading into the fall or overall, or whatever information you can provide to us?
Right. So as we've been talking about the last few months, the real estate market continues to be very strong in Rhode Island. Single-family prices up 13%. But as we have been discussing this, the actual number of sales dropped 4%. And as the constant conversation has been this year, it's really a lack of inventory. Single-family homes, 13% less homes for sale than this time last year. And I'm sure if you looked at that 2 years back, it'd be even more. Condo inventory down, multifamily inventory down, but prices and sales in those two categories have been coming up. What I think a lot of people forget, or they think, is that the winter and the holidays are a bad time to sell a house. The issue is historically that inventory is always less in the winter, right? This year even more because there's less homes. But people that are considering selling their home, if you really want to capitalize, this is a great time. There's no homes, there's very few homes for sale, and you're just fighting against less competition. So what will happen in the spring, and typically what happens every spring, is you get an influx of inventory, which will, if you're fighting against 5 neighbors, you're not going to get a higher price. Whereas now there's very few homes. So people that are considering the sale of their home, this is a great time to sell a house.
So I hadn't thought about it, but it strikes me that it's in some senses similar to the stock market trading volumes that we were just talking about. A big reason why stock market volumes are down is because the market's doing well. People are hanging on to their investment, and volume and inventory are kind of synonymous in the sense that you can't do a lot of transactions in real estate if there are not a lot of sellers willing to sell their houses. Is that essentially the issue?
All the sales are still up, and I mean, obviously the single family numbers.
The prices are, but the quantity of transactions
in single families are down because there's less homes for sale. Somehow the condos and the multifamilies are still keeping pace. I mean, up 15%, up 22%, even though the inventory is down between 5 and 20%.
So what limited transactions there are, and same thing in the stock market, what limited trading there is, it's on rising prices.
Absolutely.
But there's just not a lot of transactions happening, or at least not as many as when you're looking back this time last year or something like that.
And if you sell high, you're also buying high in this market too, right? I mean, it's kind of, they affect each other.
Sure. So given how strong the market is, to what extent does that, as we get into our topic today, which is the decision that people have to make, and probably everybody's going to be faced with this decision at some point in their lives, about whether they should rent a place to live or whether they should actually buy a home. And to what extent does the state of the market right now play into that decision, do you find? Does it make people want to buy more when the market's so strong, or is it discouraging people because there aren't a lot of choices out there?
Well, I think you have kind of probably a combination of the two, right? Because if rent prices rise, it makes more sense to own a home, right? And we'll talk about the benefits of home ownership versus being a tenant. But it's hard because that first-time homebuyer category is probably the toughest. That 350 and under category is very difficult. And well, there's just a lot of people trying to buy those homes. And Rhode Island's got a lot of aggressive programs right now with Rhode Island housing grants, and you can really buy houses with little money down.
So we're going to get into some of the decision-making factors, but I was thinking about this segment and what viewers may think, and they say, oh, you know, Oliver has Chad on, he's a real estate agent, he's going to tell everybody to buy a house. But people might not realize your office deals with not only helping renters find rentals, but you have clients that own rental property. So your business is wrapped up in the rental market just as it's wrapped up in the purchase market, is
Absolutely.
it not?
Yeah, our office does hundreds of rentals a year.
So with that even-minded disclaimer, let's talk about some of the considerations. So I would imagine that one of the big considerations people particularly for potential first-time home buyers, is simply going to be budget. Like how much money do you have to spend on housing? How does that number play a role, or should it play a role in people's decision-making?
Well, once again, what we're seeing is like 10 years ago, you can buy a house with very little money down. You know, 0% in certain towns with USDA funding. 3% down is fairly common, or 5% down. Rhode Island Housing, as I said, gives you first-time home buyer grants. So that helps people, but you need to look at it, right? Because there's a lot of things, budgeting, and some of the things we'll talk about. I mean, if your roof leaks, let's say, and you don't have an extra $10,000 laying around in the bank, or you're better off being a tenant or a homeowner. You gotta look at it financially and say, is it the right time? Can I absorb some of those costs if those things happen? Because I mean, you own a home, I own a home. We know those things happen, right? Your hot water goes, it's going to go.
So the typical sort of calculus I think a lot of people do is they look at it and they say, gee, I'm paying $1,800 a month in rent.
Right.
I could apply that to mortgage, insurance, taxes, et cetera, but I don't have money for the down payment. What you're saying is the climate for purchasing with little or no money down is a lot better than maybe it was 8 years ago or shortly after the financial crisis.
Yeah, they are, and there's a lot of those programs out there now where you can do that, even short money. We were talking about earlier, though, you got to remember when you're putting less than 20% down on a home, they usually tack on mortgage insurance. They call it PMI. So that wears, bearing too, because now you're paying a couple $100s a month in just incremental insurance to it and ensure that, because you're putting so little money down. So that's, I think, a big budgeting factor as well, that a lot of people say, well, I'm paying $1,800 a month, and I could pay a mortgage with that, but then you got to tack on the taxes, the insurance, the PMI if you're not putting a substantial down payment down.
So you got to put pen to paper and really figure out, exactly what it's going to cost you. Another consideration I have to believe is critical for people is simply the time that you think you're going to be in that particular location, whether it's in that town or that state, or you have a job or whatever. How do you help people figure out, maybe if they're only going to be there 3 months, it's obvious that renting makes a lot more sense. But is there sort of a dividing line where you say, less than this amount of time probably doesn't make sense, more than this amount of time probably makes sense? How do you help people through that decision?
I think they really need to analyze the flexibility they're going to need in the future. I mean, your average homeowner stays in their house probably 5 to 7 years is the national average. If you're going to buy a house, but you're not sure about your job or if you're going to move, I mean, sometimes a shorter term lease or a lease is a better flexible option for you. If you don't know where your career path's going and you might change in the next 18 or 24 months, it probably doesn't make sense to buy a house. But if you're going to be here 5 years or 7 years and you can gain that equity that you get in buying a home, absolutely.
So you got to factor in the time. I remember, I moved to Indiana for a time. It's an interesting experience for a guy that lived in Rhode Island almost all his life, but bought a house, and we only owned it for 2.5 years. I think we were fortunate that we sold it for maybe a couple $100 more than we bought it for. I mean, you factor in real estate commissions, we lost a little bit of money, but that's amortized over 2.5 years of living. I don't see that that's a big deal, but there's certainly a risk there, right? That the value of the property could decline to some extent in a short amount of time.
Or if the market shifts and there's a lot of inventory and you need to move, I mean, it could take time to sell that house.
So there are clearly financial reasons that make buying attractive, and we hit on them from time to time in the show, but perhaps we could talk a little bit about two of the key ones. And the first one is building equity. I mean, that's one of those things that makes home ownership attractive. Why is that? I mean, what is building equity? What are we talking about?
Well, if you look at MLS or real estate historically, like everything else, the market always goes up when you draw a graph. It might have its ebbs and flows in between, but historically speaking, MLS prices tend to go up 3 to 4% a year over the long term. So, I mean, if you're building a portfolio, I mean, you're the financial guy in the room, and you want home ownership, I believe, is one of those things you have to consider. right? I mean, I don't want to be paying off somebody else's mortgage by being a tenant my whole life. To me, I'd rather own my own home, make my own decisions. If I want to, you know, change out a kitchen or do a roof, I mean, those are my decisions to make. So, I mean, home ownership is always there's always an equity in the long term of it. Like we just said, flexibility. I mean, if you're going to move in a year, you may not have a big equitable gain, but if you're going to be there 5 years, 10 years, 20 years, that house is typically going to be worth more later.
There are also some tax advantages that people should be aware of. And we'll give the disclaimer, this is as the rules are now, they're in flux, and we will talk about that a lot on the show, but as the rules stand now, there's some tax advantages to being a homeowner, are there not?
Absolutely. So your property taxes are one thing you can write off on your personal taxes, and then your insurance is another. So there's a lot of tax benefits that come with the home ownership. Mortgage interest deduction is huge.
Right. Sure.
It's huge. So I mean, if you're looking at those things in your taxes, I mean, those are two huge benefits.
Not all the decisions are money-based, though. Some of them are lifestyle choices. What are some lifestyles that would lend themselves to one choice or the other?
Well, once again, we talked about the flexibility. You know, right? If you're not going to be around too long, or if you travel a lot, maybe it's better to be a tenant.
If you don't like dealing with maintenance, I would say
maintenance is a huge one, right? I mean, the houses are there's always something you can be doing with a house. So,
but on the flip side of that, wouldn't you agree that living in your own home gives you a lot more freedom to be able to do it? You even want to plant a garden there or paint this room that color.
Absolutely. I was having a conversation with a friend this morning about who's renting a house short term, and he said he was looking forward to buying his new house this spring, and same thing. If you don't have to answer to anybody if you own it yourself.
So a lot of considerations both ways. It's important to know yourself, know your budget, and know your situation, and go from there. Chad, great information as always.
Man.
Thank you very much. All right, up next we're going to be talking about Morningstar star ratings. Stay with us. There's more to come here on the Money Pros. Welcome back to the Money Pros. If you invest in mutual funds, you're probably familiar with the company Morningstar. It's a publicly traded organization that specializes in data analytics for the mutual fund industry, and a lot of consumers use Morningstar as well as a lot of advisors. In fact, I'm a big fan of Morningstar. I use Morningstar. They've got great information, particularly on mutual funds, but also on stocks and exchange-traded funds and a variety of other investments. And data is king in this business. And Morningstar is at the top of the heap. In fact, they have a virtual monopoly on providing data analytics to and for the mutual fund industry. There are a couple of other players, but candidly, in comparison to Morningstar, the other players are really bit players. $16 trillion in mutual funds in the United States, and Morningstar follows all of it. In fact, they rank via their star rankings, 10,800 different funds. And if you factor in the fact that they rank all different share classes of those funds, the actual number of funds is in the tens of thousands that they follow. And they provide a star ranking, which is similar to a review on Amazon. Investors rely on Morningstar star rankings, similar to Amazon customers rely on rankings for any particular product they might buy on Amazon. Mutual fund companies, and many investors aren't aware of this, mutual fund companies spend tens of millions of dollars a year licensing Morningstar information so that the mutual fund companies themselves can advertise their star rankings, all with the idea that star rankings are somehow predictive, potentially, of future performance. But Morningstar would be the first to tell you that they don't intend their star rankings this way. However, it didn't stop the Wall Street Journal from writing an interesting expose covering the effectiveness of star rankings. Let's throw up a slide and talk about some of their findings. The first thing they found was that star rankings matter to investors. Inevitably, when a mutual fund moved up from a 3 to a 4 or 4 to a 5-star ranking, those mutual funds saw significant cash inflows. Morningstar star rankings make a difference to investors and to mutual fund companies. Next, 5-star overall funds do not tend to repeat. It's really surprising what the Wall Street Journal found, but most 5-star funds in a particular period didn't wind up on the whole becoming 5-star funds in a following period. So it was not a very good predictor of future performance. And finally, there's a significant fall off even more so than the rest of the five-star funds when it comes to domestic stock funds, which is the largest category. So here are some things to keep in mind if you're an investor and you're looking at star rankings as part of your decision making. Star rankings are backward looking. It's more like a grade in class, like how did I do in math, not how will I do in the next math class. Expenses remain the best determining factor for how a mutual fund is going to do. So if you want a determinative variable, just look at how expensive the fund is. The cheapest ones tend to do the best. And finally, the trend toward indexing really makes these star rankings to some extent a moot point. So the caution is simply buyer beware. Don't take star rankings to be the be-all, end-all of how good a mutual fund is. There are other criteria that you definitely need to consider. All right, that's it for that segment. Up next, we're going to answer a viewer question on a coming market correction. Stay with us. There's more to come. Welcome back to the Money Pros, viewer question time. And this is actually a client question. He's in fact a viewer too, so I guess it counts. And he asked recently, somewhat off the cuff in fact, he said, I follow a lot of market news from a bunch of different sources, which is good to know. Do you believe some recent predictions that we are due for a correction in the stock market? And my answer would have to be, yeah, we're due. In fact, we talked about this on a previous show. Corrections, which are 10% declines in the stock market, generally happen every 12 to 18 months. It's been a little over 18 months since we've had one. So from that standpoint, we're due. Now, do I see anything on the horizon that would suggest that one was coming? No. But though you don't usually see those things in the horizon, you usually see them in the rear view mirror. The issue here is that it doesn't really matter. If you are going to try to predict when corrections are going to come and be out of the market when they come and get into the market after they pass, you are going to keep yourself up at night and in all likelihood are going to be a very unsuccessful investor. So the real key to that question is, it doesn't matter. It's going to come. It's going to happen eventually. There's nothing we can do about it. Corrections are a normal part of the market. I would not let that dissuade you from your overall investment activities. So with that, I will bid you a great Sunday. Thanks for watching The Money Pros. We look forward to seeing you again back here next Sunday, right here on The Money Pros. Take care, folks.